Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have David Stockman with me today to discuss why, amongst other issues, the Fed can't keep the stock market rising forever, and why we may be nearing the end of the second longest stock market bubble in our history. Well, most of you are very much aware of David Stockman, though perhaps many of you who are much younger than I don't remember how prominent he was in the national news for a few weeks back in the early 1980s when Democrats had a field day because, well, David Stockman dared to tell his boss, Ronald Reagan, the truth about tax cuts and budget deficits. David was never really, I think I'm fair in saying he was never really sold on the idea of supply-side economics as Art Laffer and Larry Kudlow and some others in the administration were. But he's always been forthright in telling people what he believes, and that's really why David is one of my favorite people. I always admire people who really tell the truth, even when it doesn't benefit them and when it may come at some cost to them. So I think our country would be a whole lot better off if we had more people that tell the truth and let the chips fall where they may, as I think David has practiced throughout his life. For example, on April 24th, in an interview on Fox Business with Maria Bartiromo and another very hostile lady anchor, don't really remember what her name is. Well, David was at his combative best, and I would encourage all of you to watch that interview on YouTube. The link to that interview, you probably catch it at David's website, but it's also available at miningstocks.com, along with a lot of other free market orientated articles that appear on my website at miningstocks.com. Thanks for joining me again today, David.
Happy to join you, and I appreciate your recollection way back to the early 1980s.
Well, I'm old enough to do that.
Jay, I would say about that, I never did believe in some kind of economic magic about tax cuts, but I did profoundly think we needed much smaller government that would permit far lower taxes that would therefore unleash the, vital energies of the capitalist free market, and that prosperity would unfold from there. But the difference I had with some of the more politically oriented so-called economists back then advising President Reagan was I felt you had to earn the smaller government by the tough job of taking on the entitlements, of recognizing that there's waste on both sides of the Potomac, that is the Pentagon side, as well as all the far-flung domestic agencies, and that therefore you needed a two-pronged, balanced program of cutting taxes and cutting spending, because back then, which is profoundly different than today, and I think it goes to, the current issue on people's mind. Back then, people still feared that big government deficits and huge treasury borrowing would cause a crowding out effect in the bond market, in the capital markets, and if you crowded out, you obviously drove interest rates upward, and in the end reduced private investment in business especially, but also in residential housing and the other investment categories. So, and that was true, actually.
Yeah.
And what happened in 1987 and 1988 is as the Reagan deficits exploded to unseen, unheard of levels, 5-6% of GDP, $200 billion a year. It doesn't seem like much now, but back then it was frightful. We almost got the day of reckoning when the stock market crashed in October 1987, the famous 22% meltdown Monday or Black Monday. What happened at that crucial juncture is that Greenspan, the so-called gold bug hard money man, had just been put in at the Fed, panicked, opened up the spigots, and much to his surprise, everything calmed down, and he was a hero in Washington, and he never got over it. And from there, we were off to the races, 30 years of what I call monetary central planning, bubble finance. There's a lot of different ways you can describe it, but it led to what I would call a 30-year interregnum, where the federal government could get away with massive borrowing and a huge and steady increase in the public debt without the collateral effect of crowding out and pushing yields up and causing a crisis in the capital markets and in the private investment sector. Well, what I'm saying today, and why I got into that huge spat with the one of the hosts on Fox that morning, is that era is over. Even the Keynesians at the Fed have finally recognized you can't run the printing press red hot for all time, into eternity. They have now pivoted big time to what they're calling QT, which is simply shrinking the balance sheet, and instead of buying up the debt of the federal government and thereby easing the supply-demand balance in the bond markets, they're now going to be shrinking their balance sheet, which is the same as dumping bonds into the federal debt into bond pits. And it's a entirely different dynamic. I call it the combined financial arms of the federal government. Both arms, the Treasury and the Fed, are going to be dumping supply into the bond markets in dimensions that we've never seen before 10 years into a business cycle. They're going to borrow $1.2 trillion of new debt at the Treasury. The Fed will be dumping $600 billion of existing debt into the same market. Now, that's roughly 9% of GDP. Nothing like it at this late stage of a business cycle. We're really long in the tooth here. And it's kind of the end game, the culmination of a 30-year trip into economic fantasy land that began in the latter part of Reagan's term after the deficits got out of control and the supply-siders convinced him not to worry about it, and then Greenspan bailed out the situation and put us on the road to this tremendous disorder that we have today. So that's a long story, but yeah. It's the 30-year encapsulated summary of how we got from there to here. There being a wonderful idea of lower taxes and a smaller government. There being $22 trillion of public debt heading to $34 trillion within a decade by the Fed's or by CBO's own reckoning, and they have rosy colored glasses on doing it. So it's a different world. It's a dangerous world, and it's about to change big time. And that's why the stock market can't keep going up because the bond market is going to start coming unstuck in a ethical way.
All right, David, I would like to ask you, going back to 1987, the stock market crash, I remember it very well. I was working in a bank at the time. Wow, it was frightening. It was downright frightening, and the Wall Street Journal reported there were no takers for the most creditworthy, strong companies. There were no buyers of the shares of General Motors and some of the other strongest companies. It was indeed a very, very frightening period of time. I can remember being extremely unnerved by it all. And that was the time, though, that something was created called I guess the Wall Street Journal called it the plunge protection team. You weren't any longer at the administration with President Reagan, I believe, during the 87 crash, right? You had gone on to work?
No, actually, I had left the White House by then because I could no longer justify these huge deficits and the claim that, well, if we waited long enough, we'd grow our way out of it. But anyway, I went to Wall Street, was a partner at Salomon Brothers, and I remember the morning well. Probably I was even more intimidated than you were.
Sure.
And this is an interesting anecdote because I was asked that morning, it was a conference in Florida that Salomon Brothers was having for all of its institutional investors, the insurance companies, the pension funds, and mutual funds, and so forth. And I was giving a speech right as the market opened. That was back before, the days of cell phones and Twitter and all the rest of it. But I still noticed that I thought it was a very impolite chatter going on in the audience, and then one by one people were getting up and leaving.
Wow.
And by the time I finished my foreshortened speech, there was practically no one left in the room.
Interesting.
And there was a reason for it, because the market had, plunged within the time that I was speaking, which wasn't all that long, I think by 15%, and it was still going down. So, we haven't seen anything like that for the last 30 years, although we did have a few scary days when the dot-com ionized in the spring of 2000, then also some really bad days in October through February of the so-called financial crisis. But since then, the market has been artificially supported and manipulated and pegged by a central bank that is completely out of control. But even that central bank, the Fed, and other central banks, for that matter, around the world, have finally recognized they've got to back off, this kind of monster bubble they created. Now, they have the arrogant belief, twofold. One, that they can slowly, bring this back, this bubble back down to earth. And secondly, that for all of their handiwork, they have created a Goldilocks economy. In fact, I just saw John Williams, who, as you know, the Fed president in San Francisco, is now going to take over really the number 2 job, the Fed president in New York, which runs the open market desk. And he was again saying we're pretty much in a Goldilocks economy. You would think after the way that both Wall Street and the Fed heads got burned in the summer fall of 2007 and where they ended up in October the next year, that word would be banished from the vocabulary. But here they are back, crowing about 3.9% unemployment on the Fed's completely, manipulated and distorted, the BLS's manipulated and distorted unemployment rate. And they don't see at all the fragility of the financial system, which I believe is very close to the edge, or the weakness of and the imbalance in the Main Street economy. And I was writing about that today, and I just want to pass on one statistic that I have in my blog today, David Stockman's Contra Corner, because it's startling. And that is, I indexed the industrial production, which is real physical output of the economy. And, even though we're in 24/7 social media world today, I guess, still, I don't think there are too many rational people that would suggest you can have a prosperous economy without industrial production, right?
Sure.
But anyway, if you index that back to November of 2007, the eve of the financial crisis, and here we are in May 2018, so, it's almost 11 years later. We went through the whole crisis, and allegedly we recovered entirely. Here's the point. Industrial production today is only 1% higher than it was way back then.
Wow.
But real personal consumption expenditures for durable goods are up 53%.
Oh.
Okay, now how in the world can we spend, we're talking apples to apples here, this is physical or real units, not inflationary nominal dollars. How can you consume 53% more when you've produced only 1% more?
Yeah.
Well, you can do it, but you can't do it for a sustained or extended period of time. And you better be alert for the fact that when you have imbalances of that magnitude, there is a grave risk that something is going to come unstuck, that you're going to be surprised when things don't continue along the path of Goldilocks economy that our Fed heads and the Wall Street economists are talking about. So I think, that's just another data point, and there are many of them that tell us, we're living on borrowed time, I think is the bottom line of the whole thing.
Yeah, for sure. Well, many, many data points, and this is one of the things I would just tell my listeners in your daily blog. There is so much meat, so much material there that really makes your case. While you can't live the lie forever. Eventually, it's going to catch up with us. And this is the point, David, that the Fed has now recognized it can't continue pushing money, interest rates down forever. It's come to grips with that, it seems, to an extent anyway. But this is going to be extremely painful. How much higher do you think interest rates can go before it trips the system, before we have the next collapse in the equity markets? And the other thing is, David, it seems to me that going back to the plunge protection issue, or the more politely termed the President's Working Group, it seems to me what happens as soon as the stock market starts to collapse, all of a sudden there's some major buyers stepping in the futures markets, perhaps, to steady it and keep it from collapsing entirely. In other words, just trying to keep people's confidence from collapsing. And how much longer can they do that? And then how will they respond when this thing comes unglued again? Because won't we go back for another gigantic, even bigger cycle? Because none of these cycles have been allowed to completely correct. We've never gone back to correcting it, going back to the 1987 even. It's just one pile of credit and debt on top of another. And how many more of these bubble cycles, bigger and bigger cycles, can we go before the whole system comes tumbling down?
Well, you really have some great questions there, and it's kind of the whole jigsaw puzzle of the non-sustainability equation that we're enmeshed in. But I'd say the first point is that the market is at the famous Willie E. Coyote moment. Remember roadrunners out there pedaling away furiously over the edge of the cliff, and suddenly realizes he's suspended in midair. Well, I think that's where the stock market has been for at least the last 2 years from the election. I got a little thing in my blog today showing the 200-day moving average in the stock market, and every time the market is dropped onto that 200-day moving average, it has bounced back. But lately, it has not been due to any cash infusion or dollar stimulus by the Fed, because they stopped that in late 2014. There's been some indirect help because the ECB was buying like there's no tomorrow during the 2 years after the Fed stopped. And, of course, the Bank of Japan keeps printing money in large dimension as well. Nevertheless, I think mainly, as I said in my blog today, those bounces off the 200 DMA have been faith-based rather than Fed-enabled. And when one of these days, when we get some kind of black swan, or I call it orange swan after the guy in the Oval Office, or red swan if the red Ponzi in China really begins to come unraveled, which I think the potential is enormously there, some kind of shock is going to wake the market up to the fact that the Fed isn't there. There isn't a Powell put anywhere near where the market is today, because Powell and the rest of them believe they've done such a great job of reviving the economy after the crisis and the Great Recession, that somehow now it's as strong as an ox and that it's running on its own momentum, and that therefore they can undertake the next step, which is not, as you and I would look at it, a return to sound money and perhaps, setting aside the, quote, emergency measures that, Bernanke and the others justified at the time of the crisis. It's not that they have had some kind of moment of enlightenment, but it's really a imperative coming from institutional thinking that their enormous power in our financial system and in our democracy, really, they have more power than any senator or cabinet officer, if you're sitting on the open market committee, is due to the fact that they can always rescue the economy, not actually, but in appearance from a recession. And that's really what gives them their political authority and credibility and independence. And if they don't have the capacity to quickly and promptly remedy the next recession, which even they know is not that far around the corner, we're in month 107 of this expansion. The longest in history was 119 months in the 90s when things were a lot better than they are today. But if they don't have the dry powder regathered, reinstituted, they won't be in a position to help. Now, what I mean by that is when the crisis came in early 2000 with .com, they were at 6.25% interest rates. They got it all the way down to 1%, got a mortgage boom going and a short-lived housing boom. But they looked like they were magicians at the time. And then in 2008, when we had the next crisis, overnight rate, the funds rate was 5.75, and they got it way down to zero. Now, my point is today they've barely got the funds rate off the flat line. And they don't have any running room to cure the next recession. Right. So they are now hell-bent on normalizing both interest rates, but especially their balance sheet, shrinking it down substantially so that next time when the cavalry is needed to deal with the inevitable business cycle contractions that occur, they'll be ready, able, and effective. But and that's important because, you listen to some of these talking heads on Wall Street, and it's always been over the last couple of years about how data dependent the Fed is and how Yellen had her 19, displays on her monitor of different aspects of the labor market and other incoming data that she looked at. The point here is they're not at all data dependent on QT, on this 600 billion per year shrinkage rate, which is going to begin in October of the Fed's balance sheet. That's an institutional imperative. It's a march that won't stop unless things really get bad. And if the market really falls apart, when they realize there is not a Powell put at the 200-day moving average, which is, only 100 points slower than where we are now, we're going to really, have a day of reckoning, I think.
So you really think that they'll stick to this, to the policies, the QT policies? They really will pull money out of the system,
yes.
Unless all hell breaks loose, and then they'll gun it again, won't they? They'll pump huge amounts of money back into the system. And then what happens to the Fed's credibility?
Well, I think that's that's kind of a chicken and egg, but I don't think the market's going to collapse all at once. It's going to kind of stair-step its way down as the dip buyers become less and less confident that they know where the floor is, where the put is, because I think it's dramatically lower than where the market closed today at 26.72 on the S&P 500. I think it's hundreds of points below that, and they're going to, allow the market to drift lower. Now, there will be open mouth intervention. In other words, you had some Fed heads talking about how steady as she goes and a bunch of other meaningless stuff like that, or they may skip a meeting in terms of a scheduled interest rate. But frankly, what they're doing today is not a result of forward guidance or as a result of 25 basis point increases in the federal funds rate, which nobody pays anyway. It's not a real interest rate. What is important is the cash drain of their balance sheet shrinkage operation. And, the interest rate thing is kind of a misdirection. And it's something Wall Street is totally obsessed with because that's the way the Fed has operated historically. But we're now in an environment where, they've taken the balance sheet from about $800 billion at the time of the crisis to $4.5 trillion, and they're now in a big-time shrinkage that totally overshadows and overwhelms the impact of what they're doing on the interest rate. And that shrinkage, I I think they will keep going, and as they stay on that path for the next few months or quarters, the market is going to be stair-stepping its way down, trying to find the bottom where the Powell put becomes effective. Now, frankly, I don't know where it is, but I'm sure it's a lot lower than it is today, and it's very probable that in that search for the new Powell put, that the market will, lose confidence, and then you have all of these built-in mechanisms, the ETFs and all of the levered bond funds and the risk parity trades. The market is full of these devices that could all start unwinding, and then the market will drop big time before the Fed can get its guns back out. So I think this is going to be a totally different cycle than last time. I'm not sure where the bottom's going to be. It's a lot lower than it is now, but it's going to be an L-shaped rather than a V-shaped bottom because the Fed doesn't have any dry powder.
Any dry powder left? Well, we're basically out of time, but just perhaps take a few more seconds to answer a couple of quick questions. Where do you think this takes us? And it's a different kind of a cycle. Last time we saw, a collapse in prices, commodity prices, gold even went down briefly, but then when the Fed started goosing the system, gold and some other things, commodities had quite a run, and of course housing prices ultimately came back artificially stimulated by more and more money putting into the system, all kinds of other government intervention. But what's your best take? What should investors really be doing now? Getting out of stocks, of course, getting out of bonds, building cash, owning some gold. What would you suggest?
I think there are two things. One, the one asset that I believe will appreciate when everything else is resetting and correcting lower is gold, because when we get the reset lower on bond prices, which are clearly going to happen, yields will be at 3.54% on the 10-year within a year, in my judgment, and the reset in the stock market, which will be hundreds of points lower than where it is today, the gold will become the asset of choice because it's the one monetary instrument, let's say, that the central banks really cannot easily manipulate. So I would say cash is a good thing to build because stuff will be a lot cheaper to buy several years down the road, and gold is a good thing to buy now because the price will move inversely to the correction on Wall Street that is I think just around the corner.
All right. Well, there you have it, folks, from David Stockman. Not only was he an advisor to President Reagan, he's also a professional Wall Streeter. I don't know if he wears that badge with pride or not, but he certainly knows the money markets inside and out, and he's always been a very honest person, always giving his views, what he believes, even when it wasn't self-serving. David, I want to thank you very much for being with us again. And, folks, it's David Stockman's ContraCorner.com. Go there to learn more about it. He's a very reasonably priced, affordable service, I must say. I pay for it, enjoy it every day. Thank you, David, for being with us again. I hope we can talk to you again sometime fairly soon.
Jay, we certainly will, because this story is just getting started.
Oh, I'm afraid it is, and I'm not sure that I'm happy about that, but it is what it is, and we want to be prepared for it as best we can.